Leveraged trading is one of those highly controversial subjects. Some view instruments like futures and swaps as directly responsible for the wild moves in the crypto markets. Some see them as a tool to actually hedge said price moves and temper volatility. Some people see them as a dangerous product that have wrecked many inexperienced traders. Others view them as an essential tool when used responsibly. So then, who's right? Well, that's exactly what this video will explore. I'll take a look at both arguments and break them down, separating fact from fiction. We'll also explore some of the more unsavory practices in the space, as well as some of my personal tips when it comes to using these instruments. Oh, and by the way, I recently reached 50,000 subscribers. Thank you guys, it means a lot. To show my appreciation, I'm giving away a free Ledger Nano X. So be sure to stick around for more info on that. Now, just a quick bit of legal mumbo-jumbo before we crack on. I am not a financial advisor in any way, shape or form. I am a YouTuber that loves making videos for your educational purposes only. And if you're new to the channel, my name is Guy. I regularly cover news, reviews and crypto analysis. So if that's something that you would gain from, be sure to smash that subscribe button. You may also want to flick on those notifications to be plugged into the YouTube matrix. Okay, enough fluff, let's dive right in. Before I can take an in-depth look into the leverage trading industry, we need a bit of an intro to it. Feel free to skip ahead if you are already well versed. So, what is leverage trading? Well, quite simply, it's trading with more money than you have. To expand on that a bit more, it's entering positions on the market that are many multiples of what you're putting down as collateral. This collateral is more commonly called your margin, and it usually measured as a percentage of the amount that you can trade with. So, for example, if the margin is 20% of the position, it implies a leverage of 5 times. Margin of 10%, 10 times, etc. This means that your position is levered up by a certain factor. Gains and losses are magnified by said factor. It's this quality of leverage trading that can either make it lucrative or deadly, depending on which side of the trade you are. Now, leverage trading is quite broad, and there are a number of different instruments that can give you leverage. You have futures, swaps, CFDs, or even just pure margin borrowing to trade. Of course, there is another aspect to some of these leveraged instruments, and that is their ability to be used to short sell an asset. This basically means that you'll be able to make money from a fall in the price of said asset. Okay, so that is a basic overview of what leveraged instruments are. But in order to understand their role in the crypto markets, we have to take a brief look at their history in traditional finance. Futures instruments are almost as old as finance itself. They were initially used centuries ago as a method for farmers to hedge the risk out of forward prices for commodities. They would sell their product into the future in order to secure a price for it when it came to market. Fast forward a few decades and these instruments became tradable products on large exchanges such as the Chicago Mercantile Exchange. No longer were they just a product to hedge the risk for farmers and buyers, but they became a method to speculate on the price of a commodity. Of course, who just wants to speculate on soybeans and orange juice? Futures markets eventually rolled out to the currency markets in the early 1970s, interest rate markets in 1975, and stock indexes in the 1980s. Eventually, by the 2000s, you had futures instruments on single stocks as well. These were mostly traded by institutional investors on large regulated exchanges such as the CME and CBOE. Those traders would keep margin accounts at exchange members which required less than the notional size of the contract. These margin accounts were pretty high and hence implied a leverage of only between 3 to 5 times. The fact that futures were not offered to retail traders is an important point though. There were indeed quite high risks that came with trading them. Losses could be multiples of the margin, and retail investors were not considered well versed enough to trade these financial products. Eventually though, these did make their way into the retail markets through the numerous online brokerage accounts offered to US traders. Futures and margin borrowing were no longer exclusively the purview of institutional investors. However, leverage limits have remained between 5 to 20 times depending on the asset. Also, it's worth noting that these brokers are heavily scrutinized by the likes of the US Securities and Exchange Commission and the CFTC. Anyways, fast forward to early 2013 when trading started picking up in a new and relatively unexplored market. That was, of course, the Bitcoin market, and with it came the opportunity to offer exotic and unchecked leverage trading instruments. One of the first exchanges to offer leveraged Bitcoin trading through futures was Bitmex. Registered in the Seychelles and ran out of Hong Kong, this was one of the predominant Bitcoin futures exchanges for a number of years. They gave Bitcoin traders the opportunity to trade their perpetual futures instruments of up to 100 times. Of course, given that the Bitcoin markets are largely anonymous and anyone could have created an account, anyone could have traded there. And they did. From large-scale whales with considerable heft down to your small-scale minnows hoping to cut their teeth in leveraged Bitcoin trading. The thing is that whales eat minnows, and so do exchanges. Bitmex started generating a reputation as being a bit of a meat grinder for the small fry. An extremely efficient liquidation engine was pretty effective at cutting highly leveraged traders down to size. Without any oversight, regulation or competition, Bitmex literally controlled the Bitcoin futures market. There were also a number of rumors that they operated their own trading desk and used their users' positions to their own advantage. It would be akin to playing poker with someone when they can see your cards. Traders still flock to the exchange, however. The allure of being able to make 100 times your initial investment on a single trade was overwhelming. However, not only were the cards stacked against these traders, but they also had no clue what they were doing. Forums were flooded by cautionary tales of traders who got wrecked. And speaking of wrecked, there was actually a Twitter bot that was started to track the size of the liquidations on the Bitmex exchange. Talk about rubbing salt into a wound. Okay, I don't mean to scare you away from leverage trading entirely. I just wanted to give you a bit of a background of it in the crypto markets. Bitmex has since restricted US accounts and they have a lot more competition, so they've had to defend their market share. There are a plethora of futures exchanges that have opened up in multiple regions. Here is just a handful of them. Deribit, Bybit, FTX, Femex, Cumex. You also then have numerous spot crypto exchanges that have either offered their own futures products or enabled some form of leverage trading. These include Binance, Kraken, Huobi, and OKX. Heck, even Coinbase has enabled some margin trading functionality on their platform, albeit with lower leverage limits. Something else also happened back in 2017. The CME and CBOE both released their own regulated and exchange-listed Bitcoin futures. Demand for these products has steadily been increasing over the past 3 years. This was mainly driven by a surge in institutional interest in Bitcoin futures. So much so that other providers like Rekt also listed their own physically settled Bitcoin futures, the first of its kind. So the point is that the Bitcoin futures and leverage trading market has evolved quite a bit. Much like the spot Bitcoin markets themselves, they're less Wild West, more Wall Street. Less unregulated online casino, more sophisticated and regulated instruments. Now, of course, this is the general statement about the shape of the Bitcoin futures and leverage trading market. At the end of the day, it always comes down to the individual trader and how they use it. It's a tool that can either be used effectively in a risk-managed way or irresponsibly in a reckless and destructive manner. So let's take a look at some of those do's and don'ts. The first major responsible use case for futures instruments is actually as a mechanism to reduce your portfolio risk. Essentially, it's a method for market participants to hedge out the volatility of the underlying asset. Think about an asset manager that has a large physical Bitcoin portfolio. They may want to reduce the risk around a potentially volatile period, the halving, for example. They could then short the futures market and effectively eliminate that risk. Or what about miners that are bringing new Bitcoin to the market? How do they secure that price for their product? Much like the farmers of ye olde times, they want a method in order to be able to sell the product at a predetermined price in the future. Of course, not all those who are using futures are going to be hedging. There are many that are trading them as they are a more cost-effective method than trading the physical coin itself. If you're a Bitcoin trader, you want to be able to maximize your return for a given price move. Leverage helps you do that. Those who use leverage responsibly are also generally more experienced with trading in general. They would have made money in the spot market but preferred to enhance those gains. They also always place stop losses and know exactly how to avoid particular trading mistakes. Finally, they also know how much leverage is enough. This is a clear distinction between them and beginners. They know that you don't really need more than 10 times leverage to be able to trade effectively and responsibly for the long term. This is in stark contrast to those that are using futures instruments and leverage trading irresponsibly. And sadly, it's these people who the exchanges make most of their money off of. So, what is this irresponsible behavior of which I speak? Well, right off the bat, people should not be trading with leverage if they don't know how to trade spot. If you are not going to make a profit trading with no leverage, you sure as hell ain't going to with leverage. You should also not be using leverage if you don't know how it works or how to manage it. Most tend to forget that it's a double-edged sword that can also chop you down to size if not controlled on the downside. For example, many still do not trade with stop losses, which is daft if you ask me. However, perhaps the biggest mistake that these traders make is the amount of leverage that they take on. Exchanges will flash a headline number of 100 times leverage, and those new to the game will go and open up an order with that exposure. This sets them up perfectly as fodder for exchange liquidation engines. Even minute moves in the price of Bitcoin can have large impacts on the P&L of your position. Let's also not forget that Bitcoin is one of the most volatile markets in the world, so you can be damn sure that it will whipsaw much quicker than the stock you traded on Robinhood last week. It's also no coincidence that the leverage factors and margin requirements on regulated exchanges or retail brokers is much lower. This could either be down to regulations or whether high leverage levels are even demanded. For example, over at Bybit, the initial margin requirement is about 37%, which implies a leverage of only about 2.7 times. On the CME, margin could be as high as almost 50%, which implies a leverage of only about 2 times. Now, of course, this is indeed quite low for many professional traders, but it shows you how little leverage is really needed for a product to be appealing to retail investors. The guys who manage billions of dollars are perfectly fine using this leverage, so why do you need 50 or even 100 times leverage? The main reason that anyone would want to trade with such high leverage ratios is because of the same reason that they throw some numbers down on a roulette wheel. It's not trading, it's gambling. And this gambling is great business for the exchanges. So let's touch on that. At the end of the day, an exchange is just a centralized trading engine that matches buyers and sellers of futures contracts. They will charge commission on all of the trades that they match. Pretty straightforward. Apart from facilitating the exchange, they also make sure that the trading pool is kept solvent. They have to make sure that in the event of extreme market moves, those that are close to depleting their margin will have their position closed. This is to protect what is called bankruptcy in the position. To do this, exchanges operate liquidation engines. These are basically mechanisms that will close out trades at the liquidation level. This liquidation level is usually above or below the bankruptcy level depending on whether it is long or short. Having this buffer in place ensures that the exchange is able to close your position long before it threatens the solvency of the pool. And when they run their liquidation engine, it executes trades, which of course mean trading fees for the exchange. So, quite simply, higher leverage means more liquidations, which means more trades, which means more trading fees for the exchange. Not only is the exchange earning bank on that liquidation, but they're also using any excess funds after the liquidation is executed to fund their insurance pool. Okay, now so what the hell is that? Well, it's a reserve fund that will be used in order to prevent situations of socialized losses. Basically, those situations in which the other side of the trade are harmed. Those insurance funds can grow to become immense. For example, over at Bitmex, the fund stands at over 37,000 Bitcoin, all funded from the margin of Rekt margin traders. If you're not convinced that high leverage is suboptimal, then I encourage you to take a look at this blog post. It's a really insightful analysis that explains the liquidation and bankruptcy price gap. Long story short, The larger the leverage, the larger the gap, the more likely a liquidation and the more chance of your margin being chucked into the insurance fund. High leverage also has a broader impact on the spot Bitcoin market. As more traders use excessive leverage, it leads to precarious situations ripe for mass market liquidations. All one needs is a small price adjustment and a cascade of liquidations whipsaws the spot Bitcoin market. Only those who could see a mass liquidation event coming, whales, etc., will profit from this. Everyone else is left holding the bag. So yes, on every level, high leverage, that above 10 times, is suboptimal for everyone apart from the exchange. So, how do you use leverage responsibly? Well, firstly, you should consider if you even want to do it. Have you traded in the spot market before, and have you developed a trading strategy? This could be a fundamental one based on price action or a more technical one that is shaped by the charts. Do you have a money management strategy? Essentially, you should know exactly how much you're willing to trade. This should be viewed as a completely separate component from your HODL portfolio. It should also be funds that you should be comfortably able to lose without breaking the bank. You should then decide on what exchange you want to trade. As mentioned, you have a plethora of different options now. Heck, the chances are that if you're already using any large crypto exchange, then they could have a margin trading or futures feature. Exactly what exchanges you use will depend on the functionality you need as well as the coins that you want to trade. And that, my people, is my dive into leverage trading. In the end, it's a really touchy subject. Some view them as instruments that have been shilled to inexperienced traders to benefit whales and exchanges. However, one can't paint the entire billion-dollar Bitcoin futures market with the same brush. Leverage trading, when used responsibly, can optimize portfolios and actually reduce risk. It's not about the instrument itself, but how it's being used. Irresponsible, swashbuckling trading will wreck people whether they trade Bitcoin 100 times, go all in on some shitcoin, or sink all their ETH into a DeFi lending pool. Risks should be assessed and managed. Yes, it is true that some leveraged exchanges make it all too easy for beginners to get wrecked. They offer the same instruments to those traders with years of experience as they do with those who just started trading a few days ago. But that's why it's imperative that those margin trading on these exchanges understand exactly what they're doing. They need to know just why high leverage is suboptimal and dangerous. If we have less people trading these instruments as a casino and more people using them in a responsible manner, we'll have less people with unpleasant experiences. Moreover, if we have fewer people leveraging the markets to the tits, then we won't have those extreme price swings that make the markets feel like a goddamn roller coaster. And that's it, my fellow crypto fans, my overview of leverage trading in the crypto markets. And of course, now is the time to let you know more about that Ledger Nano X giveaway. I want to hear some content suggestions from you people. Particular video styles or topics to cover? I'm always looking to improve the quality, and you guys are the best guide. The person with the most useful suggestion wins that ledger. I'm really looking forward to hearing your feedback. And of course, if you enjoyed this content, then please do fire up the likes. If you want to see more of my content, then feel free to subscribe. I'm working on my next video, which will be with you very soon.